If you've ever looked at a stock chart and felt completely lost, this video is for you. Those charts with lines, colors, and numbers everywhere, they're actually way simpler than they look. Today, I'm going to teach you 6 basic strategies that professional traders use to make money. No fancy jargon, no complicated math, just simple patterns that anyone can learn. By the end of this video, you'll be able to look at any stock chart and actually understand what's happening. Let's start from the very beginning. Chart basics. Before we dive into strategies, let me show you how to read a stock chart in 30 seconds. Every stock chart shows you one thing: the price of a stock over time. Time goes from left to right. Old prices on the left, new prices on the right. Price goes up and down. Higher on the chart means more expensive, lower on the chart means cheaper. Now, those colored bars you see, those are called candlesticks. Think of each candlestick like a summary of one day. Green candlesticks mean the stock went up that day. The stock started the day at the bottom of the green bar and ended at the top. Red candlesticks mean the stock went down that day. The stock started at the top of the red bar and ended at the bottom. That's it. When traders say bullish, they just mean the price is going up. When they say bearish, they mean the price is going down. Bullish equals up, bearish equals down. Simple. Now you know enough to understand the 6 strategies. Let's go. Number 1, support and resistance. Support and resistance are the most important concepts in trading. They're basically invisible floors and ceilings that prices bounce off. Imagine you're bouncing a basketball. You throw it down, it hits the floor, and it bounces back up. Then it hits the ceiling and bounces back down. Support is the floor. Resistance is the ceiling. Prices do the exact same thing. Support is a price level where the stock stops falling and bounces back up. It's like a safety net. Every time the price drops to that level, buyers jump in and push it back up. Resistance is a price level where the stock stops rising and drops back down. It's like a brick wall. Every time the price climbs to that level, sellers jump in and push it back down. Here's a real example using simple numbers. Let's say Netflix stock keeps bouncing off $400. 3 times in the past 2 months, Netflix dropped down to $400 and then bounced right back up. That $400 level is support. It's the floor. Now, Netflix is at $450 and starting to drop. You watch it fall to $420, then $410, then $400. Right at $400, you see it stop falling and start going back up. That's your signal. You buy Netflix at $400 because history shows it bounces at this level. Sure enough, Netflix climbs back to $430. Why does this work? Because traders have memories. When a stock bounces off a price level multiple times, everyone remembers it. The next time the stock gets close to that level, traders expect another bounce, so they buy before it even hits the level, which actually causes the bounce to happen. It becomes a self-fulfilling prophecy. The same thing works in reverse. If Apple stock keeps getting rejected at $180, unable to break above it, then 180 is resistance. It's the ceiling. When Apple climbs from 170 and approaches 180, you watch for it to get pushed back down. If it does, you either sell or you wait for it to break through before buying. Here's the key. The more times a level holds, the stronger it becomes. If a floor has held 5 times, it's a strong floor. If it's only held once, it's a weak floor. Strong floors and ceilings are more reliable. Number 2, trend lines. Trend lines show you which direction a stock is moving. Is it going up over time? Is it going down? Or is it just bouncing sideways? Think of a stock price like walking up or down stairs. When you walk upstairs, each step is higher than the last one. When you walk downstairs, each step is lower than the last one. Stock prices make stairs too. An uptrend means the stock is making stairs going up. Each time it drops, it doesn't drop as low as before. Each time it climbs higher than before. It's literally making a staircase pointing up. A downtrend means the stock is making stairs going down. Each time it climbs, it doesn't climb as high as before. Each time it drops lower than before. Staircase pointing down. Trend lines are just lines you draw connecting those stairs. In an uptrend, you draw a line connecting the bottoms of the stairs. That line slopes upward and acts like a ramp. The stock tends to bounce off this ramp and keep climbing. In a downtrend, you draw a line connecting the tops of the stairs. That line slopes downward and acts like a slide. the stock tends to get pushed down by this slide and keep falling. Real example with easy numbers. Tesla stock is climbing. It goes from 600 to 650, drops back to 620, climbs to 700, drops back to 650, climbs to 750. Notice the pattern? Each bottom is higher than the last. 600, then 620, then 650. Stairs going up. You draw a line connecting those bottoms. That line is your uptrend line. Tesla keeps climbing to 800, then it starts dropping. It falls to 760, then 720, then it touches your trend line at 680. That touch is your signal. You buy at 680 because the trend line has acted like a ramp 3 times already. Tesla bounces off the ramp and climbs back to 750. The simple rule: if you see stairs going up, draw a line under them. If you see stairs going down, draw a line over them. When the price touches that line, it usually bounces. If this is making sense so far, hit that like button. It tells me you want more beginner-friendly videos like this. And subscribe so you don't miss the next one. All right, back to the strategies. Number 3, moving averages. Moving averages sound complicated, but they're actually super simple. A moving average is just the average price of a stock over a certain number of days, and it shows up as a smooth line on your chart. Think about your grades in school. If you got an 80 on test 1, a 90 on test 2, and a 70 on test 3, your average grade is 80. Stock prices work the same way. If a stock was at $100 on day 1, 110 on day 2, and 90 on day 3, the average price is 100. The moving average just plots that average as a line on your chart. The most popular moving averages are the 50-day and the 200-day. The 50-day average shows you the average price over the last 50 days. The 200-day shows the average over the last 200 days. Your charting app calculates these automatically. You just need to look at them. Here's the dead simple rule that works. If the price is above the line, the trend is up. If the price is below the line, the trend is down. That's it. You don't need to calculate anything. Just look. Is the price above or below the line? But moving averages do something even cooler. They act like moving floors. During an uptrend, when the stock price is above the moving average, the price tends to bounce off that line like it's bouncing off a trampoline. Real example: Amazon is going up and trading above its 50-day moving average line. The line is sloping upward. Over a few weeks, Amazon keeps pulling back and touching that line, then bouncing and continuing higher. First, it touches the line at 130, bounces to 140, pulls back again, touches at 135, bounces to 145, pulls back a third time, touches at 140, bounces to 150. That moving average line is acting like a moving floor, giving you multiple chances to buy during the uptrend. The beauty of moving averages is they adjust automatically. Unlike support, which stays at one fixed price, the moving average moves with the stock, constantly updating. It's like having a smart floor that knows where it should be. Simple rule: price above the line equals things are going up. Price below the line equals things are going down. When price touches the line during an uptrend, consider buying. Number 4, volume. Volume is the easiest concept to understand, but beginners always ignore it. Volume just means how many people are buying and selling. High volume means lots of people are trading. Low volume means very few people are trading. Think of volume like a crowd at a concert. If there's a huge crowd of 10,000 people, that's high volume. Lots of energy, lots of action. If there are only 50 people, that's low volume. Quiet, not much happening. Why does this matter for trading? Because volume tells you if a price move is real or fake. If a stock jumps up on high volume, it means lots of people are buying. Real money is flowing in. That move will probably continue. If a stock jumps up on low volume, it means only a few people are buying. Weak move, it'll probably reverse. Here's the simple rule: big price moves should come with big volume. If you see a big price move with tiny volume, don't trust it. Real example with round numbers. Nike stock has been bouncing between 100 and 110 for a month, not really going anywhere. Then one day, Nike breaks above 110 and climbs to 115. You check the volume. Normally, about 1 million people trade Nike each day. On this breakout day, 5 million people traded. That's 5 times normal. Huge crowd showed up. This tells you the breakout is real. Big institutions with serious money are buying. You buy Nike at 115 and it runs to 125 because the volume confirmed the move was legit. Compare that to a different scenario. Nike breaks above 110, but volume is only 500,000, half the normal amount. Tiny crowd. This tells you the breakout is weak. Just a few random people buying, not serious money. Sure enough, Nike gets pushed back below 110 the next day. Fake breakout. Volume warned you. Always check volume on big moves. If the volume matches the move, it's probably real. If volume is weak, be careful. Number 5. Simple candlestick patterns. Remember those green and red bars we talked about at the beginning? Those candlesticks? Some of them form special shapes that predict what happens next. Let me teach you the 2 easiest and most powerful patterns. First pattern, the hammer. A hammer candlestick looks like a hammer. It has a small box at the top and a long stick pointing down. This forms at the bottom after a stock has been falling. Here's what it means. During that day, sellers pushed the price way down, but by the end of the day, buyers pushed it right back up. The long stick shows how far down it went. The small box at the top shows it closed near the high. This is buyers saying, no, we're not going any lower. It's a signal the stock is about to go back up. Second pattern, the shooting star. This is the opposite of the hammer. It has a small box at the bottom and a long stick pointing up. This forms at the top after a stock has been climbing. Here's what it means. During that day, buyers pushed the price way up, but by the end of the day, sellers pushed it right back down. The long stick shows how far up it went. The small box at the bottom shows it closed near the low. This is sellers saying, no, we're not going any higher. It's a signal the stock is about to go back down. Real example, Microsoft has been dropping down to 310. At 310, you see a hammer form, long stick pointing down to 305, but the close is back up at 309. Buyers rejected the lower price and pushed back. You buy Microsoft at 310. It then rallies back to 329. These patterns work because they show you the exact moment when one side wins the battle. The hammer shows buyers winning. The shooting star shows sellers winning. When you see these, you know which direction is coming next. Number 6, protecting your money. The last strategy isn't about reading charts. It's about not losing all your money. This is called risk management, and it's the most important thing you'll learn. Here's the golden rule. Never bet more than a tiny piece of your money on one trade. Specifically, never risk more than 2% of your total money on a single trade. Let me explain with easy numbers. Let's say you have $1,000 to trade with. 2% of $1,000 is $20. That means on any single trade, you should only risk losing $20 maximum. Not 200, not 100, just 20. How do you do this? By using something called a stop loss. A stop loss is just a safety exit. Before you buy anything, you decide, if I'm wrong, where will I get out? Let's say you buy a stock at $50. You decide if it drops to $48, you were wrong and you'll sell. That's a $2 loss per share. If you're willing to risk $20 total, you can buy 10 shares. 10 shares times $2 equals $20 total risk. Why is this so important? Because it keeps you alive when you're wrong. And trust me, you will be wrong a lot, especially when you're learning. If you risk 2% per trade, you can be wrong 20 times in a row before you lose 40% of your money. That gives you tons of room to learn and make mistakes without blowing up your account. Most beginners ignore this. They risk 10 or 20% per trade because they want to get rich quick. Then they're wrong 3 times and they've lost half their money. Game over. The boring truth about trading: protecting your money is more important than making money. Make small bets. Use stop losses. Stay in the game long enough to actually learn. There you have it. 6 simple strategies that anyone can learn. Support and resistance to find floors and ceilings. Trend lines to see which direction things are going. Moving averages to ride trends. Volume to confirm moves are real. Candlestick patterns to spot reversals. And risk management to protect your money. Here's what I want you to do next. Don't rush into trading with real money. I know it's tempting, but don't do it yet. Instead, practice these 6 strategies with fake money first. Most trading apps offer something called paper trading or demo accounts, where you can practice with pretend money. It feels real, looks real, but you can't actually lose anything. Spend at least a month practicing. Draw support and resistance on charts. Draw trend lines. Watch how prices bounce off moving averages. Check volume on breakouts. Spot hammer and shooting star patterns. Practice using stop losses to protect your fake money. Do this until these strategies become automatic, until you can look at any chart and immediately see what's happening. Only after you're consistently making fake money for at least a month should you even think about using real money. And when you do start with real money, start small, really small. You're still learning. Treat it like paying for an education. If you found this helpful, I need 2 things from you. First, smash that like button. It helps this video reach other beginners who need simple explanations like this. Second, subscribe and turn on notifications, because I make videos like this every week. Simple strategies, no jargon, just clear explanations that actually make sense. Now go practice, open up some charts, start looking for these patterns. You'll be amazed how quickly things start making sense once you know what to look for. Thanks for watching, and I'll see you in the next one.